Welcome to the Deep Dive. We take the complex world of earnings calls and boil it down for you. Today, we're looking at Cognyte Software Ltd. That's ticker CGNT. Specifically, their Q2 fiscal year 2026 results, which dropped pre-market September 9th. We've gone through the call, the press release, the whole lot.
Yeah, and this one's particularly interesting. A real study in contrast, actually. You had management sounding pretty positive, delivering decent numbers, even bumping up guidance for the year.
Right.
But then you look at the market reaction, well, let's just say it wasn't exactly enthusiastic. Shares took quite a hit. So our job today is to try and unpack that disconnect for you, understand the numbers, understand management's take, and then figure out why the market maybe saw things a bit differently.
Okay, let's jump straight in. Give us the headline numbers for Q2. What did Cognyte actually report?
All right, so revenue was $97.5 million. That's up a solid 15.5% compared to last year. And it did edge out analyst expectations, which were, clustered around $95.8 million. So modest beat there.
Okay, top line looks decent. What about profitability?
Profitability showed some good signs too. Adjusted EBITDA, that grew 33% year over year to $11.0 million. Non-GAAP gross margin expanded a bit, 81 basis points, landing at 72.1%.
And GAAP operating income?
That actually flipped positive, came in at $2.7 million. That's up from a loss in the same quarter last year, so that's a definite improvement on the GAAP side.
Okay, so revenue beat, profit expansion, positive GAAP operating income. On paper, that sounds pretty good.
You'd think so, right?
But as you hinted, the market reaction told a different story. What happened there?
Yeah, it was quite stark. Despite those numbers and, what sounded like a confident management team on the call, the stock fell about 12% in pre-market trading, and it traded even lower during the main U.S. session, down around $8.16 at one point, and on pretty heavy volume, too.
Wow, 12%.
Yeah, it signals, some significant near-term bearishness from investors, a real disconnect from the results they just posted.
Okay, so let's try and bridge that disconnect. What did management point to as the key drivers behind those numbers? What was working well for them?
The big story, and what they really emphasized, was the software segment performance. This is core to their strategy, shifting towards these higher margin software deals. And software revenue itself, it jumped almost 36% year over year.
36%, okay.
Yeah, 35.9% to be exact, which, massively outpaced the overall revenue growth. When you look at total software revenue, so licenses plus services, it made up about 85.5% of their total revenue in Q2. That really shows the shift is happening.
That's a significant chunk. And does their order book back up future growth? What's the visibility like?
Was pretty solid on that front. Billings were strong, $93.0 million, up about 19.5% year over year. And they highlighted their RPO, remaining performance obligations. Total RPO is $574.5 million.
Okay.
But the key one is the short-term RPO. That's what they expect to turn into revenue over the next 12 months. And that stood at $355 million.
So decent near-term visibility then.
That's certainly how management presented it, yeah. They also mentioned recurring revenue was $47.4 million, mostly support contracts, making up nearly half, 48.7% of total revenue. That provides a nice stable base.
Right, okay. Now, one thing that might have caught investors' eyes was the cash flow number. It was negative for the quarter, wasn't it?
Yeah. That's definitely something you notice. Negative cash flow from operations of $6.3 million and a negative free cash flow of $8.9 million.
How did they explain that? Seems counterintuitive with the revenue growth.
They addressed it directly. Management said this is actually a typical seasonal pattern for them in Q2. It's largely down to when they pay out bonuses. And importantly, despite that Q2 dip, they reiterated their full-year guidance for operating cash flow, expecting around $45 million for the year.
Okay, so seasonal timing, not necessarily an underlying issue, according to them.
Exactly. They're framing it as a temporary blip, not a trend. But, negative cash flow numbers always get scrutinized.
Absolutely. And beyond operations, what about their capital management? Any moves there that signal confidence?
Definitely. They finished up their previous $20 million share buyback program and then immediately authorized a new $20 million program running through January 2027.
Okay, putting money back into their own stock.
Right. Which, when you combine it with their cash position, they have about $84.7 million in cash and zero debt. It does send a message of confidence from management about their financial health and future cash generation. Oh, and another point, maybe not strictly financial, but relevant context. That class action lawsuit they were facing, fully dismissed during the quarter.
Right. That removes a potential distraction and cost overhang.
Exactly. Cleans things up a bit.
Okay, let's shift gears to the strategy and the market.
Hmm.
The CEO talked a lot about AI-driven investigative analytics and winning deals. What's their take on the demand environment?
They painted a picture of really strong demand. They basically argued their tech is becoming indispensable. Their clients are these critical government and security agencies, law enforcement, military intelligence, national security,
High-stakes customers.
very high stakes. And these agencies are facing, well, a data explosion, right? And adversaries who are getting smarter and more sophisticated all the time. So Cognyte positions their AI platform covering everything from signal processing to insight mining to the actual investigative analytics as the necessary tool to handle that complexity. It's not just nice to have, it's mission critical.
And they backed that up with examples, I recall, some big wins.
They did. They highlighted two significant military intelligence deals, one in Asia Pacific, one in the EMEA region, totaling $20 million combined. And they also mentioned a proof of concept in a large U.S. city that apparently directly led to arrests. So trying to show tangible impact.
Real world results.
Yeah, moving beyond just the tech specs. And they also pointed to external validation. Gartner featured them as a sample vendor for AI-powered predictive analytics and public safety, calling the benefits transformational.
Okay, so they feel good about their tech and its relatives.
Yeah.
How did that translate into their financial outlook?
They raised guidance, right? They did, yeah. Raised the full year guidance for fiscal 26. Revenue is now expected around $397 million, plus or minus 2%. That's about 13% growth year over year at the midpoint.
Solid growth.
It is. But the bigger jump was on the adjusted EBITDA line. They boosted that guidance significantly, now expecting around $45 million. That implies roughly 55% growth year over year. So they're projecting really strong operating leverage kicking in.
55% EBITDA growth is definitely eye-catching.
It is. And non-GAAP EPS guidance was also lifted to around $0.23. So positive revisions across the board.
And they didn't stop there. They looked further out, too.
That's right. They reaffirmed their longer-term targets, still aiming for $500 million in revenue by fiscal year 2028. Alongside gross margins around 73% and adjusted EBITDA margins getting above 20%.
Ambitious targets.
Definitely ambitious. They attribute their confidence there to, the growing market need, their tech leadership, and what they called consistent execution.
Okay, let's pivot to the Q&A part of the call. Sometimes you get more color there. What about the U.S. market specifically? It's obviously key.
Yeah, the U.S. came up quite a bit. They see it as a major growth engine, absolutely. They're actively investing there, building partnerships like the one with LexisNexis Risk Solutions for the federal space.
But there were some headwinds mentioned.
There were. Management was upfront about facing what they described as atypical U.S. agency procurement delays, sort of budget cycle issues, it sounds like. So while they're bullish long-term on the U.S., these delays are creating some near-term drag and mean they can't lean too heavily on U.S. growth in their immediate guidance. They expect it to pick up, but the timing is a bit uncertain.
Temporary delays can sometimes linger.
Yeah.
Okay, and in terms of how they're growing revenue, is it mostly landing new logos or expanding existing ones?
Right now, it's mainly coming from existing customers, upselling and cross-selling. So clients might be increasing data capacity, adding new data sources, or adopting more features and use cases on the platform.
Land and expand.
Pretty much the classic land and expand model. They are still focused on winning your customers, of course, but those deals tend to start smaller and then grow over time. The existing base is really driving the bulk of the growth right now.
And in such a competitive field, how are they winning deals? How are they displacing older tech? What's their edge?
They point squarely to their R&D and tech differentiation, especially the AI capabilities. Their strategy involves encouraging potential clients to do these proof of concepts or PACACs, basically head-to-head bake-offs against incumbents or other competitors.
Joe, don't just tell.
Exactly. They're confident that when clients see their platform handle complex data and generate deeper insights in a real-world test, it demonstrates clear superiority over older, maybe less AI-driven systems. That's their secret sauce for displacement.
Okay, one thing that really struck me was management consistently talking about a healthy demand environment, even with all the broader economic chatter out there. Why do they feel so insulated?
It comes back to the nature of their customers and the problems they solve. The backdrop is rising global threats, smarter adversaries, the whole complex security landscape. For government agencies, having cutting-edge intelligence tools isn't really optional or tied to economic cycles in the same way consumer spending might be. It's seen as essential. Modernizing and using AI is becoming a necessity, not a choice.
So a non-discretionary budget item, essentially.
That's the argument, yes. The demand is driven by strategic imperatives, not just economic conditions.
Okay, so let's try and tie this all together. We've got management presenting strong execution, AI tailwinds, raised guidance, but the market tanks the stock. Why the massive disconnect? What was the real sticking point for investors this quarter?
That really is the million-dollar question here, isn't it? It seems the market, despite the revenue and non-GAAP EPS beats, was maybe focused more on the quality or the magnitude of those beats. Perhaps expectations for operating leverage or cash flow were even higher than what was delivered. While GAAP operating income did improve, maybe it wasn't fast enough or strong enough for some investors, especially given the valuation the stock might have carried.
So maybe growth is good, but profitable growth and cash flow are king right now.
I think that's a big part of it, yeah. In this environment, investors are really scrutinizing the path to sustainable profitability and free cash flow. The sell-off suggests the market looked past the headline beats and maybe questioned the underlying pace of improvement or the valuation premium.
And it wasn't just a bad day for the whole sector, right? You mentioned the cybersecurity ETF, HACK, was pretty flat, so Cognyte was singled out.
Exactly. That's key context. It suggests this wasn't just broad market malaise or sector weakness hitting everyone. It points to something specific about Cognyte's results or outlook that worried investors. Maybe those U.S. procurement delays, even framed as temporary, added just enough uncertainty.
Right.
Or maybe the market just has a higher bar now for execution on both the top and bottom lines, especially when it comes to converting that RPO into actual profit and cash. The market's focus was clearly different from management's narrative this time.
Okay, that sets us up perfectly for our next segment. Let's dive into this is not financial advice. Given this weird, dynamic, positive narrative, negative reaction important, what are some outrageous but plausible trade ideas?
Well, this kind of disconnect definitely creates interesting possibilities, doesn't it? You have what looks like a potential market overreaction to maybe some short-term issues, possibly ignoring the stronger long-term story and the raised guidance. So, yeah, for those with a, let's say, higher risk tolerance, there are some ways you could think about playing this.
Okay, hit us with idea number one from the deep dive desk. All right, idea one, the AI-driven rebound play. Look, the stock got hammered, down 12, 13%. The sell-off seemed focused on maybe slightly weaker than hoped for operating leverage, despite strong software growth, clear AI demand, and that big 55% EBITDA growth forecast in the raised guidance. So an aggressive idea could be to buy out-of-the-money call options on CGNT. Maybe look at strikes 15%, 20% above where the stock settled, and give yourself some time, Q1 or Q2 2026 expiration, maybe January or April contracts.
So you're betting on sentiment turning around.
Exactly. You're betting that as they execute on the raised guide, convert that $355 million short-term RPO, and maybe those U.S. federal delays start to clear up, the market refocuses on the positives like that $500 million FY28 target. The dip could be an entry point for a leveraged bet on the long-term story playing out. High conviction needed, obviously.
Makes sense. Bold, but logical based on the disconnect. What's idea number two?
Idea two, the fundamental versus sentiment arbitrage. This one's a bit more nuanced, maybe for someone looking for a relative value play. Consider a long position in CGNT, but pair it with a short position. Maybe short a cybersecurity peer that seems less differentiated or has a higher multiple, or even just a smaller short in a broad sector ETF like HACK.
Okay, so a pairs trade. What's the thinking there?
The logic is the market might be unfairly punishing CGNT right now for perceived short-term operational misses, but fundamentally their AI value proposition, the win rates, the buybacks that all look sound, maybe even undervalued temporarily.
Right.
So by pairing the long CGNT with a short, you hedge against general market or sector downturns. You're isolating your bets specifically on Cognyte's fundamentals, eventually winning out over the current negative sentiment. You're betting the market will eventually recognize its unique strengths in AI investigative analytics compared to maybe more generic cybersecurity plays.
Interesting. So hedging the sector risk while betting on company-specific outperformance.
Precisely. A bet that fundamentals will eventually trump short-term sentiment. Okay, let's wrap up this deep dive. To quickly recap, Cognyte Software's Q2 showed, well, a mixed picture. Solid revenue growth, guidance raised.
Yeah, but offset by that really sharp negative market reaction. Investors seemed laser-focused on the pace of operating leverage improvement and maybe near-term cash flow, more so than the top-line beats.
The key takeaway really is that stark disconnect, isn't it? Management painted a cautiously bullish picture. The AI pivot, the long-term targets.
Right, versus the market's immediate reaction, which seemed much more focused on valuation and let's say, the details of the earnings beat rather than the broader narrative. It really highlights how demanding the market is right now.
Which leaves us with the big question going forward. Will Cognyte converting that big chunk of short-term RPO and landing more global deals be enough to win back investor confidence?
Or will the market continue to demand even faster, even more consistent improvement on operating income and cash flow before giving the stock credit again? That's the tension.
So what should people be watching?
Keep a close eye on how quickly that $355 million short-term RPO turns into revenue. Watch for news on those U.S. federal deals. Do the delays actually resolve? And look for any more detail they give on recurring revenue trends and margin sustainability. Your homework, really, is to form your own view. How fast can Cognyte translate that undeniable demand for their AI analytics into the kind of bottom-line results and cash flow that this skeptical market clearly wants to see?
And remember, everything we've discussed today is for informational purposes only. It is absolutely not financial advice. Please do your own research before making any investment decisions.
We've definitely given you a lot to chew on regarding Cognyte Software Ltd.
Join us next time for another deep dive into the numbers.